Markets discover, but they do not govern. Many governments believe that markets are better at solving public problems than government itself. They believe markets allocate resources more efficiently. They believe markets discover better prices. They believe markets discipline waste. They believe markets reveal demand, attract investment, correct mistakes, and identify opportunities faster than public institutions. There is truth in this. Markets are powerful discovery systems. They can reveal scarcity. They can reveal demand. They can reveal price. They can reveal risk. They can reveal where incentives are misaligned. They can reveal whether investors are willing to act. They can reveal whether consumers are willing to pay. They can reveal whether supply can respond. But there is a mistake hidden inside this truth. A market can discover what is profitable. It can discover what is scarce. It can discover what actors are willing to buy, sell, avoid, or exploit. But a market does not by itself discover what is legitimate. It does not decide what harms are admissible. It does not protect future generations. It does not define public purpose. It does not know when ecological limits have been crossed. It does not decide who should carry risk on behalf of society. That is the work of governance. This is the meaning of Doctrine XII of the governance doctrine stack. The market discovery sequencing principle, Doctrine XII, says, markets are discovery surfaces. They are not governance systems. A market is useful because it produces signals. Prices are signals. Shortages are signals. Risk premiums are signals. Rental yields are signals. Insurance withdrawal is a signal. Bank lending conditions are signals. Investment appetite is a signal. Capital flight is a signal. Supply response is a signal. But signals do not govern themselves. A signal must be interpreted. It must be constrained. It must be classified. It must pass an admissibility test before it becomes the basis for public action. In PIE terms, the correct governance sequence is signal, constraint, ontology, admissibility, action. Doctrine XII adds one crucial point. Market discovery must occur inside that sequence, not outside it. Markets may reveal important information, but government must still ask, what is this market signal actually telling us? What constraint does it reveal? What kind of problem are we dealing with? Is the proposed response admissible? Who benefits? Who pays? Who carries the risk? What public value is produced? What harms are being authorized? What happens if the market response fails? Without those questions, market discovery becomes market delegation. And market delegation is not governance. The common government fallacy looks like this. Government identifies a public problem, housing shortage, energy transition, infrastructure deficit, climate risk, regional development, food security, competition failure, public service underperformance. Then government assumes that the market will solve the problem if the right signal is sent. A tax incentive, a subsidy, a deregulation, a fast-track approval, a loan guarantee, a price mechanism, a user charge, a private partnership, a property rights adjustment,
a reduction in compliance costs. Sometimes this works, but often it fails because government has misclassified the problem. The problem was not merely a price problem. It was an infrastructure problem, a legitimacy problem, a capacity problem, a coordination problem, a public good problem, a monopoly problem, a long-term resilience problem, an ecological limit problem, a planning architecture problem. Doctrine XII warns that markets can only discover within the architecture they are given. If the architecture is wrong, the market does not fix the error. It exploits the error, it amplifies the error, it prices the error, or it reveals the error too late. That is why market discovery must be sequenced by governance. Markets discover. Governance decides what discoveries are admissible.
How market discovery fails. A government may believe that if it improves tax conditions for landlords or developers, the market will produce more homes. The assumption is simple. Better incentives, more investment, more supply, lower rents, better public outcome. But Doctrine XII says the government must not stop at the incentive. It must ask what the market is actually being asked to discover. Will private investors build new supply? Or will they buy existing homes? Will investment flow into affordable housing or into higher yield segments? Will infrastructure be available? Will councils have funding capacity? Will construction cost allow viable delivery? Will land prices absorb the incentive? Will rents fall? Or will asset values rise? Will the public subsidy produce public value or private capital gain? If government delegates housing governance to the market too early, the market may discover that the most profitable strategy is not to build the homes society needs. It may discover that existing property is safer. It may discover that land banking is profitable. It may discover that high-end development is better than affordable supply. It may discover that scarcity increases private returns. That is not the market being irrational. That is the market responding rationally to the architecture it has been given. The governance failure occurs earlier. Public purpose was not sequenced before market discovery. Now consider climate and energy transition. A government may believe that loan guarantees, subsidies, carbon pricing, or private investment signals will produce decarbonization. These tools can be useful, but Doctrine XII asks, what is the transition pathway? What emissions reduction is required? What infrastructure must exist? What technologies are mature? Which sectors can electrify? Which cannot? Who captures the subsidy? Do banks capture the benefit through reduced lending risk? Do firms capture the benefit through balance sheet improvement? Does the public capture the benefit through measurable emissions reduction? Are the results monitored? Is the support temporary, conditional, and reversible? If these questions are not answered, the market may discover something very different from what government intended. It may discover how to access public guarantees. It may discover how to delay deeper transition. It may discover how to shift risk onto taxpayers. It may discover how to rebrand ordinary investment as climate action. Doctrine XII does not say, never use markets. It says, do not ask markets to discover public purpose after the public has already accepted the risk.
The governance sequence must come first. Now consider fast-track approvals. Fast-track systems are often justified through efficiency. The argument is simple. Too much process delays investment. Delay increases costs. Therefore, faster approval will unlock development. Again, there is truth here. But Doctrine XII asks what kind of market discovery fast-track systems create. Do they discover efficient development, or do they discover political access? Do they discover high public value or high private gain? Do they reduce unnecessary delay or bypass legitimacy? Do they accelerate projects that meet public constraints or allow constraints to be negotiated after influence has already entered the system? Where approval creates large private gains, market actors will naturally search for the path of least resistance. If lobbying transparency is weak, they may discover influence channels. If environmental limits are vague, they may discover ecological loopholes. If community participation is reduced, they may discover consent without legitimacy. If public benefit tests are weak, they may discover value extraction through permission. This is why fast-track systems require stronger governance architecture, not weaker architecture. The faster the system moves, the stronger the admissibility gates must be. Now consider competition. Markets are often assumed to generate competition. But Doctrine XII warns that markets may also discover how to prevent competition. Firms can discover non-compete clauses, exclusive supply agreements, land banking, regulatory barriers, data advantages, network effects, platform lock-in, lobbying pathways, predatory pricing, strategic litigation. A market does not automatically discover fairness. It discovers advantage. Competition is not the natural state of all markets. Competition is often the product of governance architecture. So when governments assume that deregulation automatically produces competition, they may be committing a category error. The question is not simply, how do we free the market? The question is, what institutional architecture is required so that market discovery produces competition rather than concentration?
Now consider oil prices and geopolitical risk. Market prices can be powerful signals, but a price is not reality itself. Oil prices may fall because traders believe a geopolitical risk has passed. But the physical system may still be constrained by inventories, shipping routes, refinery capacity, strategic reserves, entry risk, insurance costs, or diplomatic uncertainty. Doctrine XII, therefore, distinguishes between market sentiment and material constraint. The market may discover optimism, but inventories may discover scarcity. The market may price a rumor, but shipping systems may price risk. The market may react to political language, but energy systems respond to physical flows. Government must not confuse a price movement with a completed governance assessment. Price is a signal. It must still be interpreted through constraint, ontology, admissibility, and action.
How government should apply Doctrine XII. A government applying Doctrine XII would not reject markets. It would govern market discovery. It would use markets as instruments inside public architecture. It would not treat markets as a substitute for public judgment. Before delegating a public problem to market mechanisms, government should ask 7 questions. First, what exactly do we want the market to discover? Price, demand, supply capacity, investment appetite, technology readiness, risk exposure, delivery cost, consumer preference. If government cannot answer this, it is not using the market. It is hoping. Second, what must not be left to the market? Legitimacy, rights, public goods, environmental limits, long-term resilience, basic human needs, treaty obligations, distribution of public risk, intergenerational harm. These must be governed before the market is invited to act. Third, what is the correct ontology of the problem? Is housing a price problem or a spatial governance problem? Is climate transition a finance problem or an infrastructure conversion problem? Is healthcare a consumer market or a public capacity system? Is competition a deregulation problem or a market architecture problem? Misclassification leads to failed market discovery. Fourth, who captures the benefit? Households, banks, developers, landowners, shareholders, public agencies, future generations. The climate system, the wider economy, governments must trace the benefit pathway. Fifth, who carries the downside risk? Taxpayers, councils, renters, workers, future governments, future generations, ecosystems, small competitors. If the public carries the risk, the public value test must be strong. Sixth, what is the correction mechanism? What happens if the market does not respond? What happens if the incentive is captured? What happens if prices rise? What happens if supply does not appear? What happens if emissions do not fall? What happens if monopoly power increases? A policy without a correction loop is not a governed market mechanism. 7. When does the intervention expire? If the mechanism is temporary, it must have a duration limit. If it is a subsidy, it must have conditions. If it is a guarantee, it must have public value triggers. If it is a fast track, it must have legitimacy gates. If it is deregulation, it must have monitoring and reversal points. This links Doctrine XII directly to Doctrine XIII. The containment duration principle, temporary market mechanisms may be necessary, but if temporary containment becomes permanent architecture, the intervention can invert. A subsidy becomes dependency. A guarantee becomes moral hazard. A fast track becomes capture. Deregulation becomes structural weakness. Private delivery becomes public loss of capacity. Doctrine XII is also connected to Doctrine I. The non-harm and value justification principle. Before markets are used, government must ask whether the proposed action creates harm, who bears that harm, and what public value justifies it. A market mechanism does not remove the non-harm test. It intensifies it, because markets can distribute harm invisibly through prices, access, exclusion, and risk transfer. Doctrine XII is also connected to Doctrine XI. The correction shock principle. When market discovery is badly sequenced, the system often receives correction later.
The housing supply does not arrive. The subsidy is captured. The infrastructure cost rises. The monopoly strengthens. The environmental harm accumulates. The public balance sheet absorbs private risk. Correction shock is the delayed arrival of the constraint that governance failed to recognize earlier. Doctrine XII prevents correction shock by sequencing market discovery before large-scale public exposure. It is also connected to the epistemic stability principle. Markets produce signals, but signals can be misread. A price rise may be mistaken for scarcity. A price fall may be mistaken for safety. Investor appetite may be mistaken for public value. Low demand may be mistaken for failure of interest rather than failure of conditions. Epistemic stability requires government to interpret market signals carefully using data, institutional memory, domain expertise, and public purpose tests. A doctrine can be summarized in one sentence. Markets discover within the architecture they are given. Governance is responsible for the architecture, or even more sharply, the market can tell government what is happening inside the system, but it cannot decide what the system ought to be for. Market discovery is powerful, but it is not morally complete. It is not institutionally complete. It is not ecologically complete. It is not democratically complete. It is not future-oriented by itself. A market can allocate within rules,
but it cannot decide the legitimacy of the rules. A market can price risk, but it cannot decide whether society should accept that risk. A market can reveal demand, but it cannot decide which needs are too important to leave unmet. A market can discover private opportunity, but it cannot define public value. That is why Doctrine XII matters. When governments confuse market discovery with governance, they may believe they are being realistic, efficient, and disciplined, but they may actually be committing a deeper governance failure. They may be delegating public judgment to a system that was never designed to carry it. The task is not to reject markets. The task is to sequence them. Govern first. Then allow markets to discover. Then interpret what they discover. Then correct the architecture when discovery reveals failure. That is market discovery sequencing. That is Doctrine XII of the governance doctrine stack. And it may be one of the most important doctrines for governments trying to govern in an age of housing crisis, climate transition, infrastructure stress, fiscal pressure, and declining public trust.